let's try this again. Uh, if you want the books here, you can go to realprogressives.org and look up their bookstore. It should be upper right hand. You go to categories, it'll say bookstore, book club, stuff like that. Anyway, so this is going to be a slightly longer episode. Last one was actually a little longer than I thought it was going to be. It's like 24 minutes last, but this one's going to be a little bit longer. But it's second to last video until I'm done with this chapter and I can move on. Anyway, so right now I'm on 6.5, which is the balance sheets. Following Ritter, we can present a very simple, generalized balance sheet, which would apply to any sector as being depicted in the T account shown in figure 6.6. By a T account, we are referring to a set of financial records that uses double entry bookkeeping. So let's go on to the next one. So let's see. Several points are worth noting. Real assets only appear on the balance sheets of their owners. Financial assets are different to real assets because they represent the indebtedness of other sectors. This means that they will be matched by a financial liability on at least one other sector's balance sheet. Financial assets denote monetary accounts owned by that sector, which by the same logic as before means that there will be a matching liability on at least one other balance sheet within the system. When we consider the monetary system as a whole, we conclude that financial assets and financial liabilities net to zero. That is, the total value of the financial assets equals the total value of the outstanding liabilities. Like for instance, there is 22 point something trillion in U.S. Treasuries that have yet to be redeemed. That's 22 trillion out of 30 trillion, I think, is known as the U.S. debt, or national debt, which is basically just the savings account at the Fed in the form of U.S. Treasury bonds. Anyway, so let's see. This accounting also tells us that for the overall economy, net worth equals the monetary value of the real assets in the economy. The balance sheet depicts stocks, but we can easily see how it might provide us with information about flows in the way the national accounts do. A stock is measured at a point in time, say the end of the year, whereas flows measure monetary transaction over a period, say a year. If we examine the difference between a balance sheet compiled at say 31 December 2017 and a balance sheet compiled at 31 December 2018, we will be able to represent the information in the balance sheet about or above assets, liabilities, and net worth as flow data. Consider figure 6.7, where the triangle symbol refers to changes over the period concerned. Now the entries in the T account denote uses and sources of funds, that is, flows over the period of interest. There are two components. One relates to real assets and net worth, and the other to financial assets. A given sector, for example, households, firm, and government can, in the first instance, obtain funds by increasing their liabilities through borrowing and incurring debt. They can apply those funds to accumulating more financial assets or building cash balance. You'll see the I guess the is what is called assets, then financial assets, or building cash balance, asset money, I suppose, or monetary. If we wanted to complicate matters, we could decompose. We could decompose. No, decompose. I guess it's decompose. Decompose. AFA, AM, and AL. Further, by recognizing that a given sector can also sell existing financial assets or run down cash balances to obtain new funds. Similarly, use funds to reduce liabilities, pay down debt. Thus, the entries in Figure 6.7 are to be considered as net transactions. Okay, that's what T stands for. The second source and use of funds for a sector relates to change in the real assets, or ARA, and the change in net worth, ANW, over a given period. In the National Accounts Framework, see Chapter 7, 7 forming, we considered the division between the capital account and the current account, where the former related to investment in production capacity and the latter referred to reoccurred spending and income. The capital account measured transactions which changed the real assets held and the net worth of the economy. What do we mean by a change in real assets? In the national accounts, we considered gross capital formation or investment, which is defined as expenditure on production or productive capital goods, for example, plant and equipment factories. This is a use of funds by firms in the current period. Depreciation represents the difference between gross and net investments for now, though we abstract from the real world complexity of depreciation. Finally, we consider the change in net worth for a sector in a given period to be the residual after all the sources of funds have been accounted for. From an accounting perspective, net worth is equal to the differences between total assets and total liabilities. It follows that a change in net worth over the period of interest is equal to the differences between the change in total assets and the change in total liabilities. If total assets increase by more, decrease by less, then total liabilities increase or decrease, then the net worth of the sector has risen. Another way of thinking about the change in net worth, which is a flow of funds, is to link it to the national accounts concept of saving. In the national account framework, we consider household savings, for example, to be the difference between consumption, disposable income, a source. This concept generalizes with caution in the statement that the surplus of a sector is the difference between its current revenue and its current expenditure. Excuse me. What happens to the flow of surplus funds if the current flow of income is greater than the current expenditure? Then the end of the period, the sector would have accumulated increased stock of total net assets by increasing the actual assets held and or reduced liabilities owed. The surplus between current income and current expenditure must be matched dollar for dollar by an increase in the stock of total net assets. We have already discussed total net assets above, but in different terms. In the stock of total net assets, we have already we discussed the change in net worth over a period as the difference between the change in total assets and the change in total liabilities. That difference is exactly equal to the surplus of current income over current expenditure. Thus, from an accounting perspective, we can consider savings to be the change in the net worth over a period. Figure 6.7, however, only implicitly includes the current account transactions, the flow of current income, and expenditure, since we defined the change in net worth, or ANW, to be the differences between the two current flows. The simplicity of Figure 6.7 is that it shows that if a sector is running deficit, that is, it is spending more, than it is we define the change in net worth over a period and the difference between the change in total assets and the change in total liabilities. That difference is exactly equal to the surplus of current income over current expenditure. Thus, from an accounting perspective, we can consider saving to be the change in net worth and over a period. Figure 6.7, however, only explicitly includes the current account transactions, the flow of current income and expenditure, since we define the change in net worth, ANW, to be the difference between the two current flows. The simplicity of Figure 6.7 is that it shows that if a sector is running a deficit, that is, it is spending more than it is earning, or in the parlance used above, it is investing more than it is saving, that it must obtain the deficit funds from its available sources. Increasing borrowing, or AL, is greater than 0. Running down cash balance, AM, less than 0. Selling existing financial assets, AFA, less than 0. Selling existing real assets, ARA, under less than 0. More. This section going down a little more. More generally, given the sector, for example, household, firm, government, may be running a deficit, but could choose to reduce their liabilities, AL, greater than 0, less than 0, by running down their stocks of financial assets, AFA, less than 0. Real assets, ARA, less than 0, or cash balances, AM, less than 0. Clearly there is an infinite number of combinations of changes in liabilities and changes in the holdings of the different types of assets, but overall total assets minus total liabilities net worth has declined. Conversely, a sector that is running a surplus, that is it is spending less than it is earning, or in the parlance used above, it is investing less than it is saving, must be using the surplus funds to repay debt, or AL, less than 0, build up cash balance, AM, greater than 0, increase its financial assets, increasing lending, AFA, more than 0, increase real assets, ARA, greater than 0. More generally, a given sector, for example, household, firm, government, may be running a surplus, but could choose to obtain additional funds by increasing its liabilities by borrowing and incurring debt, AL. It can apply those funds to accumulating more financial assets, or AFA, or building cash balances, AM. Again, there is an infinite number of combinations of changes in liabilities and changes in the households of the different types of assets, but overall, total assets minus total liabilities net worth has increased. If we wanted to complicate matters, we could decompose. Look at that a different way. AFA, AM, and AL further by recognizing that a given sector may sell some financial assets and buy new financial assets. Similarly, it might refinance by taking on new liabilities when existing liabilities need to be repaid. So the entries in Figure 6.7 are to be considered as net transactions. We also have to be cautious in our terminology when considering the different sectors. If we are considering members of the household sectors, then it is clear that if they spend less than their income and thus save, they are deferring current consumption in the hope that they will be able to command greater consumption in the future period. The increase in the future period, the increase in their net worth provides for increased future consumption for the household. Similarly, for a business firm, it is spending less than it is earning. We consider it to be retaining earnings, which is a source of funds to the firm in the future. And similarly, in some areas, net worth for a sector in a given period is the residual after all the uses and sources of funds have been accounted for. From an accounting perspective, net worth is equal to the difference between total assets and total liabilities. It follows that a change in net worth over the period of interest is equal to the difference between the change in total assets and the change in total liabilities. If total assets increase by more or decrease by less than total liabilities increase or decrease, then the net worth of the sector has risen. We consider the private domestic sector as a whole, the sum of the households and firms, to be saving overall if total investments by firms is less than total saving by households. From the national accounts, we consider that households save and firms invest. However, in the case of the government sector, such terminology would be misleading. If the government spends less than it takes out of the non-government sector in the form of taxation, taxation, we say it running a fiscal surplus. A fiscal deficit occurs when its spending is greater than its taxation revenue. But fiscal surplus does not increase the capacity of the sovereign government to spend in the future in the same way that a surplus savings increases the capacity of a household to spend in the future. Reminder box, we see, as we saw in Chapter 1, a sovereign currency issuing government faces no intrinsic financial constraints and can at any time purchase whatever is for sale in the currency that it issues. Its capacity to do so is not influenced by the past spending and revenue patterns. Figure 6.8 provides the most comprehensive framework for analysis the flow of funds because it brings together the current transactions, income and expenditure, the financial transactions, the capital and transactions, and that we have dealt with earlier. The capital and the financial transactions are captured and changed to the balance sheet, which is figure 6.6. Note that when we talk about the sovereign government, we are excluding the levels of government that do not issue the currency. State and local governments are more like households or firms in that respect, although they do have the capacity to tax and issue fines. Transactions above the dotted line comprise the income statement and record current expenditure, use or uses. The balancing term above the dashed line constitutes the change in net worth, A&W, or saving. The changes in the balance sheet are shown below the dashes line, and the balancing item is once again the change in net worth, or A&W. You can see that we could cancel out the change in net worth and A&W because it is the balancing item in both the income statement and the changes in the balance sheet. This would leave us with the accounting statement that sources of funds to a sector through the current income and borrowing must be used for current expenditures, investment, lending, and or building up cash balances. Next one is 6.6, the flow of funds matrix. And I'm just going to go straight through until the end of the chapter, which is about 1.5 pages or so. The flow of funds matrix. The T account tracing the sectorial sources and uses of funds can be summarized for all sectors in the economy The flow of funds transaction matrix, a stylized version of which is shown in figure 6.9. The 6.9 right here. Can't see it. Let me see if I can move this. There we go. Maybe you can see it just a little more. Okay. Anyway, if you want to, you can pause and kind of look at this in whatever form you can. Anyway, so let's see. The overriding accounting rule that governs the presentation of the flow of funds accounts is that for the economy as a whole and for each sector in the economy, the total sources of funds must be equal to the total use of funds. Remember that sources of funds provided by the various sectors in the economy are used by those sectors. Figure 6.9, taken from the Ritter 1963, shows three sectors and the total economy. At the most aggregate level, the three sectors could be the private domestic sector, the government sector, and the external sector. For each period being accounted for, the statistician would record the flows of funds that related to each of the row categories in the matrix. Most importantly, we have learned that for every deficit sector which saves less than it invests, there has to be offsetting surpluses in at least one other sector. Ritter described this result as an interlocking, self-contained system which shows for a specified time period the balances, sources, and uses of funds statements for each sector, the interrelations among the sectors, and the aggregate totals of savings, investment, leading, hoarding, and borrowing for the economy as a whole. Any one sector may invest more or less than it saves, or borrow more or less than it lends. However, for the economy as a whole, saving must necessarily equal investment, and borrowing must equal lending plus hoarding. Thus, a deficit sector which saves less than invests must be offset by at least one other surplus sector to net the flows to zero. What are the advantages of presenting economic data in this way? Various practical uses can be made of the information provided in the flow of funds accounts. And down here, you'll see that. You can pause this and kind of look this over a little bit if you don't understand it. It's the same thing over here. Pause this and if you can. I'm not sure. But anyway. Okay, so last two pages of this chapter. They provide information of all financial flows within the economy as a sector-by-sector basis. They allow researchers and policymakers to understand how funds flow from any one sector through the bank system and to final users by, for example, firms engaged in productive investment. They allow researchers and policymakers to monitor major economic trends such as the changing indebtedness of the sectors of the economy and the sources of funding for the respective sectors. For example, an understanding of the flow of funds accounts would have indicated the growing indebtedness of the private sector prior to the GFC and perhaps alerted policymakers to the likely financial instability arising from it. They allow researchers to study saving patterns in the economy and show us where the savings of a sector are being deployed. The accounts can tell us which sectors are accumulating surpluses or deficits and the division between financial and real assets. They also allow us to understand patterns of gross capital formation. They permit researchers to examine the dynamics of each concept as household wealth. We can learn how the household balance sheets change over time and how that wealth is composed. For example, one of the hallmarks of the period leading up to GFC in many countries was the shift in household wealth to riskier categories such as share purchases sourced from marginal loans. The shift in importance in overall wealth from more secure home mortgages to more risky sources of wealth was significant because it exposed the economy to an increased risk of financial instability. Central banks use the flow of funds accounts to help them estimate the sensitivity of the economy to changes in the availability of credit. Flow funds accounts and the national account. The flow of funds accounts complement the national account and the balance of payment accounts, which are produced by national statistical agencies on a regular basis as a way of measuring economic activity in total and across the broad economic sectors. We will consider the balance of payments accounts in Chapter 24. There are important differences between the flow of funds accounts and the national accounts, which can be summarized as the national account contain no data pertaining to financial transactions, borrowing, lending, or changes in cash balances. Only non-financial transactions are measured. The flow of funds accounts fill that void. The national account focuses on the current flows of financial expenditure, output, and income, as we saw in Chapter 4. Transactions that involved so-called double counting or intermediate transaction are excluded from the calculation of final expenditures. The flow of funds accounts allow us to trace transactions involving assets that have been created in past periods. The structure of the national accounts is such that consumer durable expenditure is included under current expenditure when conceptually it should be considered as an investment activity. The flow of funds accounts of sectors can invest and save. Conclusion: we began this chapter with the discussion of stocks and flows, and then introduced the concepts of sectoral balances. We showed how a sector's net income flows are related to its accumulation of financial assets and liabilities, and how one sector's balance are interrelated to another's balance. Finally, we introduced balance sheets used to account for an individual, economic entities, uses, and sources of funds. We have seen throughout the chapter how the sectoral balances framework and the accounting structures that underpin it empower us to fact check the internal logic of arguments made by politicians and media commentators about such things as government and private debt and retrenchment. The framework alone does not allow us to determine the validity politically driven pronouncements such as austerity measures will stimulate growth. At this point, we also need to apply theory, but we can and should still use the sectoral balance framework to draw macroeconomic inferences about how sectoral balances will respond to the imposition of austerity. So if a politician says that the government and non-government sectors should simultaneously reduce their net indebtedness, increase their net wealth by running surpluses, then we know that that is not possible unless the current account surplus grows. In other words, a politician who advocates belt tightening by both the domestic private sector and the government sector in order to reduce indebtedness must also explain their plan to inducing foreigners to increase their own indebtedness. To make this possible, we don't have to resort to theory to draw those sorts of conclusions. In other words, don't listen to them. Learn how government funds, learn the Constitution, as in Article 1, Section 8, and the 14th Amendment, I think it's the 4th Amendment, where it says that the debt already incurred by the government or spending shall not be questioned. So every time you hear something about the debt crisis, think of this as theater, as a way of distracting to not do what the people need for the government to do, which is provide the health care through single payer health care, provide housing by investing in more housing to those who can't really afford it in terms of their wages being stagnant. Housing should be a right. Housing should be as a constitution as a guaranteed by the government in one way or the other. Um, uh, as I said, single payer health care, federal jobs guarantee, pro-cyclical or not, doesn't matter. Either way, you put something like that in there and it'll pretty much render the interest rate hikes obsolete, because the interest rates are meant to control the flow of funds within the economy through bank credit. That hasn't worked because people still have a need for currency in one form or another. So the aggregate demand is still there. It won't be leaving anytime soon, since we all have to pay our taxes in U.S. dollar, um, and that includes bank loans that for anybody who needs a home, car, regular insurance, whatever have you. Sometimes you do have to take out a loan for insurance, but anyway. That's all I got to say as far as that part goes. And yes, next week, this channel will be MMT and other topics. I'm going to be talking about more about like politics, wrestling, my other interests other than MMT. But I encourage you to get these books at realprogressives.org. Again, it's in the bookstore. I encourage you to register for the Macro and Chill, which happens on Tuesdays, 8 p.m. Eastern. I encourage you to listen to the recent episodes of Macro and Cheese. I can't remember who was on there last, but it was a great episode. I encourage you to donate whenever you can, how much ever you can. And again, thank you for those who did donate what they could to their year-end fundraising. Um, and need more volunteers, of course. Need more people to learn MMT so they can then pass on to others who might think that taxes pay for federal government spending when it's only at the state level to begin with. But it's usually the government spending that funds those companies and people in the state and local economy in the first place. So, anyways, thanks for watching. Thanks for listening. Peace out for now.